So you're a loan officer, right? Day in and day out, you see these applicants, you punch their details into the system, and you don't ask if they're a good person, you don't ask them to pinky promise they'll pay you back. Nope, you look at one single, all-powerful, three-digit number. It's a number that can literally open doors or slam them right in someone's face. But have you ever, really, stopped to think about where that number comes from? Well, let's pull back the curtain and see how this thing is actually built.
And that's the big mystery, isn't it? Your bank uses this score to make huge decisions about a person's life. We're talking a home loan, a car, even just getting a simple credit card. But here's the kicker. They don't actually create the score. So if the bank isn't the one calling the shots on the number, then who is?
Okay, to understand the score, you first have to understand the whole system and all the key players in the game. It's not just a simple conversation between the borrower and the bank. It turns out there are some really important and kind of invisible middlemen working behind the scenes.
Now this right here, this busts the biggest myth of them all. Most people just assume their bank is the one crunching the numbers and giving them a score, but that is not how it works at all. The reality is, banks are just data reporters. They send all the information about your payments and loans to these independent companies called credit bureaus. You've probably heard of them, like CIBIL, Experian, and Equifax. These are the guys who actually do the math.
This little flowchart shows you the entire journey. So look, it all starts with you, the borrower. Every single time you swipe a credit card or pay off a loan installment, your bank, the data provider, is taking notes. Then, every month, they bundle all that up and report your behavior to the credit bureau, the score calculator. The bureau then runs its special algorithm, spits out your score, and then lenders, people like you, use that score to make their decisions. It's this constant flowing cycle of data. So, the big question, how do these bureaus calculate that one magic number? Well, it's not random, and it's not some big secret they keep locked away in a vault. While the exact algorithm is, proprietary, the ingredients are actually pretty well known. It's kind of like a recipe with 5 main ingredients. Let's break them down one by one. Take a look at this breakdown. This is basically the DNA of your credit score, and you can see right away, not all of these factors are created equal. Look at that. Just 2 of them, payment history and credit utilization, make up a whopping 65% of your entire score. So, let's start with the undisputed heavyweight champion first. Payment history. At 35%, this is the single most important piece of the entire puzzle. The best way to think about it is like your financial report card. It answers one very simple question. Does this person pay their bills on time? Every on-time payment is like a gold star. And every missed payment? That's a big, fat, red mark. It's the most direct measure of your reliability. Period. And those red marks, they hurt a lot. This shows you just how damaging one single late payment can be. If you have an excellent score, say an 820, one little slip-up can knock you down by 40 points. But, and this is important, look at that second row. If your score is already kind of low, like a 650, that same mistake can cause an even steeper drop, pushing you way down below 600. The takeaway here is absolutely crucial. A high score gives you more to lose, for sure, but a single mistake is incredibly costly no matter where you start. All right, next up, coming in at 30%, we have credit utilization. I want you to think of this as the gas tank for your credit. It's not about how much money you spend, but how much of your available credit limit you're using at any one time. See, if you're constantly running on empty, that's a major red flag for lenders. Let's make this super clear with an example. Let's say your total credit card limit is 1 lakh rupees, and this month you've spent 90,000 of it. Now, you might be planning to pay it all off, which is great. But at the exact moment the bank reports your data to the bureau, your usage looks incredibly high.
And that's the number the algorithm sees, 90%. To a lender, that looks like you're stretched really thin, maybe even in some financial trouble. Even if you're not, it signals risk. So what's the golden rule? It's simple. Try your best to keep your utilization below 30% of your total limit.
Moving on. Our next factor, making up 15% of your score, is the length of your credit history. This one is all about trust that's built up over time. It's like a long-term friendship. A longer history with accounts that are well managed shows lenders that you're stable, you're predictable. And hey, this is also why closing your oldest credit card, even if you never use it, can sometimes ding your score, because it lowers the average age of all your accounts. Now for the last 2 factors. They each weigh in at 10%. First up is credit mix.
The easiest way to think of this is like having a balanced diet. Lenders just like to see that you can handle different kinds of financial responsibilities, not just one type of debt.
And there are really only two main types to worry about. You've got secured debt, that's stuff that's backed by an asset, like a home loan or a car loan, and then you have unsecured debt, like a credit card or a personal loan, which isn't backed by anything. Having a healthy mix of both just shows you're a versatile and responsible borrower. And the final 10% is all about new credit, which is also known as hard inquiries, okay? So every time you formally apply for a loan or a new credit card, the lender pulls your report and that leaves a little footprint. Now, one or two is totally fine. But if you're firing off tons of applications in a short amount of time, it can look like you're desperate for cash. That's a major red flag for lenders, and it can definitely ding your score for a little while.
Okay, so now we know the 5 ingredients in the recipe, but how does a simple, everyday action like buying a coffee with your credit card actually turn into a data point that changes your score? Let's follow the journey of that single transaction.
It's all a monthly cycle. You swipe your card, the bank makes a note of it. Then, at the end of your billing cycle, the bank takes all your activity, your outstanding balance, whether you paid on time, and sends it off to the credit bureau. The bureau's algorithm grabs this new info, reruns the whole calculation across all 5 factors, and bam, it recalculates your score. The key thing to get here is that your score isn't static. It's a living, breathing number that's getting updated all the time, usually about every 30 days.
Now, it is really, really easy to look at this score as some kind of grade on your character or your personal worth. But that is not what it is, not even close. We've got to totally reframe how we think about the purpose of this algorithm.
If you remember one thing from all of this, let it be this. The score isn't a judgment. It's a prediction. The algorithm is just a cold, calculating machine. It doesn't know you. It doesn't care if you're a good person. It only knows patterns. It looks at your data, compares it to millions of other data points, and calculates just one thing: the statistical probability that you will be unable to pay back a loan in the near future. That's it. It's just math.
And, because people don't really get this, there are a lot of crazy myths out there. So yes, missing payments and maxing out your cards will absolutely wreck your score. But checking your own score? No way. That will never hurt it. In fact, checking it yourself is one of the smartest things you can do. It's what's called a soft inquiry, and it has zero negative impact on your score. So seriously, check it. Check it often.
So let's end with this one thought. Your credit score isn't some permanent tattoo of your past mistakes. It's actually much more like a weather forecast. It uses data from the past to predict what might happen in the near future. And just like the weather, it can change. The system is now decoded for you. You have the formula. The only question left is, what are you going to do with it? What is your score forecasting for you?